Welcome, everyone, to our first episode of the Acadium Financial Partners Roundtable, where we answer questions that we have received from our clients. I am Dawna DuClau, paraplanner, and we are joined by Frank, Tom, and Lindsey. Our first question is for Frank. How will my portfolio be affected by the midterm elections, and what should we do if either party wins?
Great question. Thanks, Donna. And more than ever, it just seems like politics is everywhere all the time. It feels like the last election never ended, and now here comes another one. It's very, very normal for people to wonder if something, then what? So if so-and-so wins, they're going to ruin everything, including the stock market, and what should we do? Everyone loves cause and effect relationships and simple explanations. But the reality is that there are many, many factors that go into stock market prices. One of them is, of course, what happens at the polls. But there's also what happens in other countries, as well as the price of oil, interest rates, innovations, the weather, so on and so on. So it's just not that easy. It's not possible to connect the dots from a political outcome to a market outcome. Now, the market is not an abstract thing that goes up and down or a kind of casino game. It's important to remember that it's companies, that we own businesses. So if so-and-so wins, people will continue watching TV. They'll continue buying soap. They will not stop shopping online, and they won't stop uploading photos of their children and pets to their social media. So it's important to remember that we own capitalism itself. Billions of people at thousands of companies working to improve their product, to enhance their service, and to lower their costs. And every day, people are voting, not just every few years. Every day, people vote with their dollars. So setting aside my own personal opinions, capital grows over time, regardless of the political environment. Through everything that's already happened in America's history, there is a remarkably linear upward trend to the market if we step back far enough to see it. And that's the power that we're trying to harness at Acadium. So thanks, Donna.
Great. Next question is for Lindsey. How has the recent bear market hurt me and my financial plan?
Excellent question, Donna. First, it's important that I stress that every investor situation is unique, but generally speaking, a bear market may not hurt a client's plan as much as they think. I would keep three things in mind regarding your financial plan and a market downturn. First, nothing in life in the short term is linear. What I mean by that is this. As people, we have good days and we have bad days. We have good years, we have bad years. The market is no different, and financial software knows this. So be confident that bear markets have already been factored into your long-term plan. So I think that's important to remember. Second, a well thought out financial plan can keep people focused on the long term. Let me give you two examples that I run into. So when we have a few good years in a row, people tend to get very confident with the value of their assets, and they may shy away from what their financial plan originally came up with, and they may be tempted to feel like they can buy things they normally wouldn't buy and potentially overspend and put their plan at risk. On the other hand, a bear market may cause people to stress and have a lot of anxiety regarding their ability to maintain their current lifestyle, even basic needs. So long-term plan will keep people focused and hopefully reduce some of that stress and risk. Finally, it's important for investors to continue to act on their plan. So again, a couple of examples. If you are younger or getting close to retirement and still making contributions, please resist the urge to pause your contributions. Buying at lower prices is always better than buying at higher prices. And on the other hand, if you are already taking money out of your investments and you're retired, it's so important to stay disciplined to rebalancing to the mix of growth and conservative assets that you set up when your plan was created. I guess that's all I have, Donna. Thank you. Very important question.
Great. And kind of jumping off your answer there, we have another question that we're going to send to Tom here. We get a lot of times, can we go to cash for a little while and see how things turn out, whether it be Ukraine, Taiwan, election?
Inflation, and so on and so on. Of course, excellent question, Donna. Probably the most consistent one I've experienced over the years. And I can certainly empathize with this ongoing dilemma because really it's the natural law as humans that we want to fix things when they're broken. Unfortunately, when it comes to investing, these actions are counterintuitive to earning the returns that you've originally taken that risk for. So let me explain what it means to see if it's a sound investment strategy or not. First, some points to consider. Over the last 95 plus years of tracking returns, it's important to know that corrections, which are a loss of 10 to 20% on the market, has happened about once every year. And bear markets, which is 20% or more loss, have happened about 1 in every 5. Cannot anchor onto those because, think about the last couple of years. During the COVID panic, we lost 34% over a 5-week period. And then just recently, from January through this June, we had a 24% loss. So nothing is predictable. But let's kind of put this in a closer context with one's retirement time horizon. Let's say 30 years. So we'll look back from the end of last month, July 31st, through all the way back to August of 1992. Important to know, the S&P returned 10% during that 30-year period, which is comprised of about 7,500 trading days. Now, if you've missed the best 22 days out of that 7,500, you only earned approximately 5% or half of that return. So it's common sense that you can't change your objectives to coincide with current conditions because you're likely going to be in that 5% camp. So, establishing a long-term strategy reinforced by principles of patience and discipline, it's just naturally going to lead to a better outcome. So, and it requires a lot less effort and anxiety, quite honestly, than trying to sell high and buy back low again. It just generally doesn't work. So, I'm going to say that my conclusion is this. We can't predict events or the market's reaction to them. We also know that the economy has market cycles, and you just don't know where that peak is or where the trough is. So the best educated course of action, I would say, is to think long-term, remain invested with a suitable allocation that's specifically designed to you and your family's own economic needs. And the only shifts that you should make is really if there's a major change that would warrant those changes. Otherwise, no, you can't go into cash. That's my firm answer.
Great. Well, that's all we have time for today. Thank you for all your thoughts as always. If you have any questions that you would like answered in our next roundtable, please call or email. We love hearing from our clients. And in the meantime, you can find more information on our website, acadiumfinancial.com. See you next time.